I want you to picture two people, both with Bitcoin. The first person heard about Bitcoin in 2020. They bought $10,000 worth near the top of the cycle, then panic sold at a $4,000 loss when the price dropped 40%. They bought back in during the next peak, chasing the hype. They've been in and out 5 times. Today, despite Bitcoin being higher than ever, they've made almost nothing. They check their portfolio with anxiety every single morning. The second person also bought Bitcoin in 2020. Same starting amount. They haven't touched it since. They didn't sell during the crash. They didn't buy more during the mania. They set a rule, a single rule, and followed it without exception. Today, their portfolio is up over 400%. They check it maybe once a month, with calm. Same asset, same starting point, completely different outcomes. This isn't a story about luck. It's a story about the hidden relationship between behavior and Bitcoin wealth that most investors never understand. Most people who lose money in Bitcoin aren't bad investors in any obvious way. They don't gamble irresponsibly, they're not reckless with their finances. They just gradually adopted a pattern of emotional decision-making that guaranteed underperformance, regardless of how good the asset actually was. Today, I'm going to walk you through the minimalist Bitcoin rules that separate people who consistently build wealth with crypto from people who consistently don't, regardless of market conditions. These aren't about timing the market. They're about understanding that every unnecessary action you take with Bitcoin has a hidden cost you probably never calculated. Let me start with a concept that will reframe how you think about every Bitcoin decision you make for the rest of your life. Every move you make in the Bitcoin market costs you twice. The first cost is obvious. It's the transaction itself, the fee, the spread, the tax event triggered. But there's a second cost that most investors completely ignore, and it's often far larger than the first. The second cost is opportunity cost. When you sell Bitcoin during a dip out of fear, you lock in a loss. But the real damage isn't the loss itself. It's that you're now out of position when the recovery comes. The average Bitcoin bear market has historically recovered to new all-time highs within 2 to 4 years. Every panic sell doesn't just cost you the loss, it costs you the recovery. The second cost also includes tax drag. In most countries, every time you sell Bitcoin at a profit, you trigger a taxable event. Frequent traders who move in and out of positions often pay 20 to 37% of their gains directly to the government, while the long-term holder pays nothing until they're ready. The minimalist approach isn't just philosophically cleaner, it's mathematically superior. The second cost includes emotional bandwidth. Every day you spend watching charts, analyzing price movements, reading speculation, and second-guessing your position is a day of mental energy spent on noise instead of signal. Researchers have found that investors who check their portfolios most frequently make the worst decisions. Attention amplifies emotion. Emotion destroys returns. I'm not done yet. The second cost includes the compounding you never received. Every dollar that left your position through a poorly timed trade is a dollar that didn't compound during the recovery. That $6,000 panic sold at the bottom of a cycle doesn't just disappear. It represents what that $6,000 would have become had it stayed invested, often 2, 3, or 4 times as much. When you add up these hidden costs, opportunity cost, tax drag, emotional bandwidth, and lost compounding, most active Bitcoin trading costs more than it earns. The transaction fees are just the entry price. The real costs continue for as long as you remain in an anxious, reactive relationship with your investment. Minimalist Bitcoin investors understand this intuitively. They're not passive because they don't care. They're passive because they've calculated the true cost of activity and decided most of it isn't worth it. Rule 1. Buy with conviction, not with FOMO. Before you buy any amount of Bitcoin, ask yourself one question. Am I buying this because I believe in it or because I'm afraid of missing out? This distinction is everything. Conviction-based buying comes from understanding what Bitcoin is, a decentralized, fixed supply asset with a verifiable monetary policy that no government can change. You understand the 21 million cap. You understand the halving cycle. You understand why scarcity matters in a world of unlimited money printing. You buy with a long time horizon because you believe the thesis. FOMO-based buying is different. It happens when Bitcoin is up 60% in a month and every headline is screaming about it. You don't want to be left behind. You buy at the peak of excitement, which is almost always the worst possible entry point. The cost per conviction calculation works like this. A $5,000 investment held for 5 years with genuine conviction costs almost nothing in emotional terms and historically has compounded dramatically. A $5,000 investment made out of FOMO and sold during the next correction costs you the spread, the tax event, the loss, and the recovery you missed, often turning a winning asset into a losing experience. Minimalist Bitcoin investors set their conviction threshold before they buy. They decide in advance, under what conditions would I sell this? If the honest answer is when the price drops significantly, they don't buy. Not because Bitcoin is bad, but because they don't have the conviction required to hold through volatility. And holding through volatility is the entire job. Rule 2. Apply the replacement test to everything in your strategy. Walk through your current Bitcoin approach and look at each element honestly. Ask yourself a simple question. If this habit or strategy disappeared today, would I spend the efforts to rebuild it? Would you readopt the habit of checking prices 3 times a day if you had to start fresh? Would you choose again to split your allocation across 11 different cryptocurrencies? Would you intentionally rebuild the pattern of buying every time there's good news and selling every time there's bad news? For most people, the honest answer is no. These habits exist through inertia, not intention. They developed gradually, without a clear decision being made. They persist because removing them requires acknowledging they were mistakes. Strategy elements that fail the replacement test have negative value. They cost you time, emotional energy, and capital without providing corresponding returns. Minimalist Bitcoin investors ruthlessly eliminate strategy elements they wouldn't choose again. The process feels uncomfortable initially, and then liberating once complete. The psychological weight of maintaining decisions you already know were wrong is substantial. Removing that weight creates mental space that's difficult to describe but immediately noticeable. Your portfolio feels more deliberate. Your decisions feel simpler. You know exactly why you own what you own, because everything remaining has a purpose. Rule 2. Never upgrade your strategy out of boredom. There's a pattern I see constantly among Bitcoin investors who have access to the right information but still underperform. They change their strategy not because it's failing, but because they're bored with its working. Their Bitcoin position is working perfectly, but a new altcoin is generating excitement. Their dollar cost averaging plan is on track, but a new trading strategy promises faster gains. Their long-term thesis is intact, but short-term noise suggests a tactical move might improve returns. Their portfolio is growing, but they've grown tired of doing nothing. These strategy changes feel like improvements. They're almost always wealth destruction disguised as optimization. Minimalist Bitcoin investors maintain a strict rule: never change a strategy that's working. A position growing according to your original thesis does not need adjustment because a new opportunity exists. An accumulation plan building wealth slowly does not need replacement because faster wealth building sounds appealing. The strategy that requires the least action is almost always the strategy that produces the most return. This discipline saves enormous sums over a market cycle. The average retail Bitcoin investor underperforms simply holding Bitcoin by 30 to 50% due to poorly timed trades. Applied across multiple cycles, the lifetime cost of strategy switching easily exceeds 6 figures. Minimalists define broken clearly. A strategy needs revision when the original thesis has fundamentally changed, not when boredom, anxiety, or a compelling video makes changing it feel appealing. Everything else is noise convincing you to solve problems you don't have. Rule 4. Create friction for selling and ease for holding. Human behavior follows the path of least resistance. If selling is easy and holding is emotionally difficult, you'll sell. If holding is easy and selling requires deliberate effort, you'll hold. Minimalist Bitcoin investors engineer their environment to make the right choice the default choice. Selling friction looks like keeping Bitcoin in cold storage rather than on an exchange, requiring a written 24-hour decision log before any sale, removing price alert apps from your home screen, unsubscribing from crypto newsletters, avoiding crypto social media during volatile periods. Holding ease looks like automated recurring purchases on payday, using a hardware wallet with a deliberate setup process, treating your Bitcoin position like a retirement account, present but not constantly managed, measuring your position in Bitcoin rather than dollars to reduce emotional price sensitivity. These structural changes matter more than willpower. Willpower depletes throughout a volatile market. Environment is constant. Someone relying on willpower to hold through a 40% drawdown will eventually sell at the worst moment when the fear peaks. Someone who has set up deliberate friction simply cannot panic sell in that moment. Minimalists don't trust themselves to consistently make perfect decisions under emotional pressure. They design systems that make good decisions automatic. The 24-hour log rule alone eliminates the majority of emotionally driven trades. Most urges to sell fade within a day if not acted on immediately. Rule 5. Track your decisions, not just your returns. This sounds obsessive until you actually do it. Tracking decisions forces accountability. Accountability prevents repetition of costly patterns. Keep a simple log of every Bitcoin decision you make: date, action, reason, emotional state at the time. Write it down. The patterns often shock investors who've never examined their decision-making objectively. What percentage of your trades were made during periods of fear or excitement?
Rather than calm analysis, how many decisions were reversed within 30 days? How did your performance compare in periods when you were active versus periods when you simply held? The data changes behavior. Once you see that your fear-based sells consistently happened at local bottoms and your excitement-based buys consistently happened at local tops, the next emotional urge feels different. You're not just making a decision, you're adding to a documented pattern of costly mistakes. Minimalist Bitcoin investors track key decision metrics over time. They set maximum thresholds, perhaps a rule that they'll only change strategy if 3 independent conditions are met simultaneously, perhaps a maximum of 2 strategy adjustments per calendar year, perhaps a one-in, one-out policy where any new position requires closing an existing one. These constraints prevent behavioral drift. Without intentional limits, strategy complexity expands to fill available anxiety. With limits, each change requires a conscious case that justifies overriding the default of inaction. Rule 6. Learn before you allocate. Most people who invest in Bitcoin do so before they understand it. They buy because it went up, because someone mentioned it at dinner, because they read a headline. They own the asset before they own the thesis. This is backwards, and it's expensive. Minimalist Bitcoin investors test their understanding before committing capital. They read the Bitcoin white paper. They understand the difference between Bitcoin and other cryptocurrencies. They can explain the halving mechanism, the supply cap, and why decentralization matters in plain terms. They understand the counterarguments and have genuine responses to them before they put real money at stake. This approach accomplishes 2 critical things. First, it reveals whether the interest is genuine or temporary. Many people who feel drawn to Bitcoin during bull markets feel nothing during bear markets. Better to discover this during the learning phase than after a significant allocation. Second, it provides the conviction required to hold. First-time Bitcoin investors almost always panic during their first major drawdown because they don't have the foundational understanding to distinguish a market correction from an asset failure. Learning before allocating means that when the 40% drop comes, you've already processed the historical precedent and you're prepared. You're not wondering if Bitcoin is over, you've already answered that question. Brokerage accounts across the world contain the financial remnants of abandoned conviction. Bitcoin bought during the hype of a bull market, sold in fear during the correction, never revisited. Minimalists avoid becoming museums of past enthusiasm. They build understanding before they build positions. Rule 7. Understand the complexity multiplier. Every layer of complexity you add to your Bitcoin strategy connects to more complexity. Adding leverage trading requires constant position monitoring, stop-loss management, liquidation risk assessment, and a fundamentally different emotional relationship with every price movement. One seemingly contained decision triggers a cascade of additional decisions. This is the complexity multiplier. Major additions multiply into ecosystems of related requirements. Watch how this plays out with common decisions. Adding altcoins requires researching each project, monitoring multiple development teams, tracking multiple market cycles that don't always correlate, and managing tax events across dozens of positions. Adding option strategies requires understanding Greeks, expiration management, and volatility modeling. Adding DeFi protocols requires understanding smart contract risk, liquidity pool mechanics, and impermanent loss calculations. Minimalists calculate the full complexity cost before any strategy addition. They know that a marginal potential return improvement might represent 10 times more cognitive load, emotional exposure, and decision-making risk. This full accounting often transforms what seemed like a reasonable enhancement into something clearly excessive. The multiplier also works in reverse. Eliminating one layer of complexity often eliminates an entire category of related mental burden. Removing leverage means no more liquidation anxiety, no more margin calls, no more sleepless nights during volatile sessions. The savings and clarity extend far beyond the apparent simplicity of the decision. Rule 7. Define your enough before the bull market starts. Here's the trap that catches even experienced Bitcoin investors. They never define what enough looks like, so they never take profit at the right time and they never feel satisfied at the right moments. Their Bitcoin position grows during a bull market. Instead of executing a predefined exit or rebalancing strategy, they keep holding because it might go higher. Then the correction comes. Their gains evaporate. They hold through the bear market waiting to return to their peak. The cycle repeats indefinitely. People who rode Bitcoin from $10,000 to $60,000 and back to $16,000 feel just as financially frustrated as people who never bought it, because they never defined the point at which they'd actually capture the win. Minimalists define enough before the emotion arrives. They decide in advance, at what price or portfolio value will I take meaningful profit? What percentage of gains will I convert to financial security versus leaving exposed to volatility? What does financial stability actually look like for me? In numbers, not in feelings. This might mean deciding that a 3x return is enough to change your financial life and actually executing that change when it arrives. It might mean deciding that a specific dollar amount in Bitcoin is your target, and anything beyond that gets partially converted to something less volatile. It might simply mean deciding that Bitcoin represents no more than a specific percentage of your total net worth, regardless of market conditions. Defining enough creates a finish line. Without it, you're running a race with no ending, where greed during peaks and fear during corrections guarantee you'll always feel like you made the wrong decision. With it, you reach a point where you've genuinely won, captured real wealth, and can observe the rest of the market cycle from a position of security rather than anxiety. Rule 9. Measure Bitcoin wealth by optionality, not price. The conventional view measures Bitcoin success by price. Is it up or down from where I bought it? Is it at an all-time high or 40% below? Minimalists measure success differently. They measure it by what the position enables. Can you leave a job that's destroying your well-being? Can you handle a financial emergency without panic? Can you take a calculated risk on something that matters to you? Can you say no to opportunities that pay well but compromise your values? These options represent true wealth. They're only available to people who've built actual financial margin, and they require liquid, accessible value, not paper gains that evaporate in the next correction. The person who bought Bitcoin impulsively, traded in and out 5 times, and is now roughly at break-even after 3 years has no optionality. They have stress and a lesson. The second investor, sitting on a 400% return with calm, got there through exceptional clarity about what the job actually requires. Both approaches are available to you regardless of when you entered the market. The choice is simply whether you want to manage your Bitcoin or whether you're comfortable letting your emotions manage it for you. The math strongly favors the first option. So does the peace of mind.